Hi there, I'm Chengyi, Head of APAC Policy in Chainalysis, and this is your Q4 2023 Asia Pacific Policy Update from the Chainalysis team. First, a quick legal disclaimer. This content is for informational purposes only and is not intended to provide legal, compliance, tax, financial, or investment advice. We encourage you to consult your own advisors in this regard, and we reiterate that Chainalysis is not responsible for any decision made or any action or non-action taken in light of this material. So for today's policy update, we're going to cover two themes. First, on the regulatory front, we're going to take a look at how regulators are continuing to build and implement regulatory regimes for digital assets in the region. And then secondly, flipping to the side of growth and innovation, we'll take a look at some of the initiatives that governments are undertaking to explore the potential of asset tokenization. So let's start first with regulation and go to Hong Kong, where the new mandatory licensing regime for virtual asset trading platforms took effect in June. So, local exchanges HashKey and OSL, which were already regulated under the earlier opt-in regime, became the first two exchanges licensed to serve retail investors after receiving a license upgrade from the Securities and Futures Commission, or SFC, in August. There are a number of other exchanges in the pipeline, mostly local players, but in November, OKX became the first major global exchange to formally submit its application. Notably, since the JPEG scandal broke, the SFC has tried to provide additional transparency to the public on who is and who isn't in the application process by publishing lists of applications under review as well as of suspicious trading platforms. And the idea here is to help the retail public navigate their choices of which platforms to engage with. Moving on from Hong Kong to Singapore, where the Monetary Authority of Singapore, or MAS, issued its finalized policy framework for stablecoin issuers in August. So the framework is aimed at enabling high-quality fiat-referenced single-currency stablecoins to be recognized as MAS-regulated stablecoins, thereby facilitating their adoption. And in order to obtain this label, stablecoins need to meet certain requirements, such as being fully backed by high-quality liquid assets and providing timely redemption to stablecoin holders. So the legislation to enact this new regime will take some time to come into force. And in the interim, MAS has begun to recognize issuers that meet its finalized requirements. So Paxos, for instance, has won in-principle approval for a US dollar stablecoin, and local issuer StraightX has received the same in respect of its Sing dollar and US dollar stablecoins. And this move to accelerate implementation of the stablecoin regime reflects MAS's strong interest in the potential benefits of stablecoins as a route to more efficient financial markets. More broadly, in a further signal of momentum, a steady flow of licenses and approvals have been granted in recent months, with the likes of Coinbase, Ripple, and Signum receiving full licenses, while players like Upbit, XREX, and GSR have received in-principle approvals. Even as it issues new licenses, MAS continues to strengthen its consumer protection framework for digital assets. So in November, MAS issued the second and final part of its consultation response on conduct and consumer protection measures for digital payment token service providers. So while Part 1 focused on custody and asset segregation, Part 2 of the response sets out standards for customer access, as well as the management of conflicts of interest, disclosure of token listing policies, and the management of technology and cyber risk. Now let's round up our regulatory update in Australia, where Treasury has published a much-anticipated consultation paper on the regulation of digital asset platforms. So the proposals here would extend the existing financial services regime to cover businesses that hold customers' digital assets. A number of horizontal financial and conduct requirements would apply, along with a host of new activity-specific requirements based on the type of service being provided. The consultation period closes on 1st of December, and draft legislation is expected to be released in 2024. So with that, let's move on now to the second policy theme today, which is asset tokenization. Now, tokenization is having a bit of a moment, and governments are getting hands-on in exploring initiatives to facilitate this activity. So earlier in November, the Hong Kong SFC issued a pair of circulars setting out its regulatory approach to tokenized securities. These circulars adopt a look-through approach whereby the complexity of a tokenized security is assessed not based on the tokenization wrapper, but based on the underlying financial product. And this is an easing of the SFC's 2019 stance classifying security tokens as complex by default, and it opens the door to retail distribution of these products. The SFC circulars will provide a boost to institutions in Hong Kong considering tokenization projects. And of course, Hong Kong is just one of a number of governments that are exploring initiatives in this space. So in Japan, the JFSA has reportedly given the Osaka Digital Exchange approval to launch a securities token proprietary trading system, paving the way for them to launch a secondary market for the trading of digital securities this year. And meanwhile, in the Philippines, the government has issued a $270 million tokenized one-year treasury bond. This relies on a dual registry structure, which means that the primary bond registry remains the existing National Registry of Scriptless Securities, but a DLT registry owned by the Bureau of the Treasury operates in parallel as a secondary registry. And we do expect other governments to increasingly start to conduct similar experiments in order to understand the technology and use cases behind asset tokenization. So let's round up finally in Singapore, where the recent FinTech Festival saw the announcement of an ambitious and intriguing Global Layer 1 initiative, conceptualized as a foundational digital infrastructure that would enable the trading of tokenized assets globally while maintaining regulatory compliance across different markets. And it does so by exploring, amongst other things, the possibility of regulatory compliance by design. This builds on the work that MAS has already been doing around Project Guardian, including the formation of a policymaker group comprising authorities from Japan, Switzerland, and the UK to explore the legal and policy considerations around asset tokenization. So this is a very long-term initiative that potentially falls into the category of moonshot, but it's also one of the most far-reaching efforts from a regulator considering an open infrastructure for private transactions and how this can be designed in a way that provides sufficient regulatory and institutional comfort for assets to move on chain at scale. And this in itself is a significant step forward in the regulatory thinking. And so on that optimistic note, that brings us to the end of this quarter's policy roundup. See you next quarter.